Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. Once again, I've asked Professor Nathan Mah to give us some insights about investing. And remember, he's an expert in value or value investing, but he also understands the power and potential of growth stock investing. And today's video is going to be on growth stock investing. Now, as Mr. Valuation, I'm a proponent of growth at a reasonable price, often referred to as GARP investing. And Nathan's going to provide some insights into what that really means here through this video. So I'm going to let Nathan talk about his views on growth investing. It can be unbelievably powerful and generate amazing returns. But as always, it comes with its own set of risks, and Nathan will cover those in his video.
Today we're going to focus on growth stocks, which are some of the more exciting types of investments to consider. There's a lot to like about growth stocks. One of the things that I really like is, especially over longer periods of time, you really benefit from compounding. So over 10, 20 years, the impact of a higher rate of return becomes magnified because of compounding. And so growth stocks are certainly worth trying to understand and worth looking at. They do come, in my mind, with some special considerations. I still think fundamentals matter, the fundamental story. Still think valuation matters, but just a couple of things that I would focus on mostly when focusing on growth stocks. First of all is, what's the source of the growth? What's the story of the growth? And this can depend a lot based on the, industry or the time that it's in. But for instance, is the growth related to there is a demand for this entire industry and this company is one of the players? That's where their growth is coming from. If that's the case, then you want to really look at the sustainability of the growth and, hey, is this trend for this entire industry likely to continue? Is this firm's place within that industry likely to continue? That becomes critical. I think sometimes historically think about like retail stocks. It used to be that with traditional retailers, one of the ways you'd grow was opening new stores. And so we look at things like the amount of growth that's from new stores versus same store sales growth. And it's like, yeah, it's great to grow from new stores, but if your same stores are seeing declining growth, that can be a little bit offsetting and can be a sign of limited sustainability of the growth, given that there's some cap on how many stores they can open. Those are just a couple of examples, but you want to be really clear, I think, on what's the story behind the growth. Is it really driven by what the firm is doing? Does this firm have a dominant position in a market, or is it going to continue to have a dominant position? Or is it more of a rising tide lifts all boats type of story where a lot of people are going to win in this space and you're trying to get in on that? The trickiest thing to me about growth stocks is valuation can be difficult. A lot of times, stocks that have already demonstrated excellent growth potential and have realized growth are going to trade at relatively high multiples. So quite often these stocks are going to look expensive if you look at past earnings or past sales that they've generated. But yet we know a lot of these companies that maybe have traded for relatively high multiples for a decade plus have generated incredible returns. So in real time, how do we know if we are overpaying for growth or if we're getting kind of growth at a reasonable price? And so I want to take a look at a few examples that I think underlie some of the potential of growth stocks and also some of the risk of growth stocks. First company I want to look at is Broadcom. I've taken the price line off here just so we can see the fundamental growth. So we're looking at adjusted operating earnings here. When you look at this full time period available to us here, that's a 31.71% adjusted earnings growth rate over this period. So that's an incredible growth. That's sustained growth. When you just look at kind of this dark green, that's steady increases. They've never really had backtrack. They've certainly never had any negative earnings over that period, and they've had pretty steady growth. And one of the things I want to point out to begin with Broadcom is a lot of times when we think of growth stocks, we think of companies that maybe aren't profitable, and certainly some growth stocks fall within that category of they're growing their sales a lot. They have the potential to grow their sales a lot, but they're not making money or generating positive cash flows. But a lot of the big returning growth stocks of the last 10 years or so have been profitable for substantial periods of time, and you would have had the chance to buy them when they were profitable, meaning you wouldn't have to necessarily focus on companies that are currently losing money to play in the growth space. And I find a lot of times when folks ask me about growth stocks, they have in mind not necessarily profitable companies already, but certainly many of the great returning companies went public when they were profitable and were pretty much always profitable. Of course, there's some examples where that's not the case too, and we'll talk about those. But for Broadcom, one thing you look at here is, again, just incredible growth. I'm going to go ahead and put the price line on here just to give us some idea of how price is tracked with fundamentals over this period. And, we talked about, there's a lot to like about growth stocks. If you kind of bought at the beginning of this period and sold at the end, that's a total return of about 9,000%. That's an annualized return of about 36%. And therein lies the power of compounding I was talking about. To really, in my mind, get the full bang for your buck with growth stocks, you have to be able to buy and hold them for a long period of time, because the longer you go on, the more you benefit from compounding. So, a 1 year, 2 year, 3 year, 30% growth is great, but you compound that over a very long period. This goes back to, November of 2009 through September of 2024, and you get these kind of incredible returns. So you really have to be able to hold a long period of time, and that's why I think focusing on the sustainability of the growth is so key. Is you are usually going to kind of get in at a relatively high multiple on these growth companies. But if they grow at a high rate for a long time, that usually solves a lot of problems that can come up with valuation. Another important lesson to me from this graph that might not be obvious because of how much overall the Broadcom stock has gone up over this period, but usually in investing, we think it's hard to get a higher return without taking on more risk. Growth stocks have the potential maybe for higher returns. With that probably comes greater risk. And so there's uncertainty about their ability to continue their growth. Also, when you're paying for a lot of future growth and there's any sort of news that says maybe the future growth isn't going to be as strong as we thought it would be, a lot of times that can cause relatively large price movements. Interestingly enough, just as I'm doing this video, you'll see Broadcom down 10% at the close from September 6th. So sometimes with these higher growth stocks, we do see these bigger swings. And if you don't sort of have the risk tolerance for those kind of swings, then you're going to miss the big growth theme over a longer period of time. I just want to show you, just looking at Broadcom's history, that you would have had to absorb relatively large short-term losses over the life of this to get that full return. So let's just take a look at a couple of those. So first of all, just going back in time a ways, from June 15th of 18 to July 13th of 18, you can see the total return was down about 24%. So a relatively short period of time, relatively big drop in stock price. Again, that drop barely shows up here because those little ups and downs look pretty small compared to the price line that we're at currently. But those are the things that in real time you'd have to be able to stick with and evaluate, hey, if I think this growth is sustainable, I know where it's coming from. Sure, the stock price has moved against me, but I believe in the growth story. You'd have to be able to hang on there. Of course, conversely, sometimes the growth story has changed and you got to know when to jump. And that goes back to me, less about price movement, even less about valuation, and more about the story of the growth. Where does the growth come from? How sustainable is it? Another more recent period from the end of December of 21 through October of 22, we see Broadcom was down about 34% over that period of time. So again, fairly recently, you would have had to live through a pretty precipitous drop, and that's over a little more extended period of time. It's about a 10-month window there that the stock kind of trended down over this period, and if you didn't hang with it, you would have missed the run-up that was coming, which, of course, even if you'd waited till things kind of, the price stabilized and you got back to the blue line at some point here, and purchased there and sold now, that's a total return of 136%, annualized return of 70%. So the point is, there are going to be some, double-digit down price movements a lot of times over longer periods for even these companies that if you look over this period, I think most people would take the Broadcom return over the length of this graph. But there have been periods of time where things would not have gone as well, and really being able to absorb that and process the story in real time would have been critical. So that's Broadcom in the past, but we might also ask, what about Broadcom right now in real time? And, in real time, we saw the price hop above this orange line, which you can see the blue line, the normal has been closer to 15. That means over this period of time, that's been closer to where Broadcom has actually traded. Based on that growth rate of 30%, that's why you get an orange line of about 30%. So just a little bit of a rule of thumb on growth stocks is when you're looking at PE ratios, that a PE ratio equal to the longer term growth rate makes sense. So, normally we would see a lower orange line, a smaller value for the PE for an orange line for typical companies. When you get into these high growth companies, then the PE equal to G becomes kind of the driving metric. And again, it makes a lot of sense to set that as a metric because you can afford to pay a higher price if you're going to get that kind of growth. That can make sense. And so, whether or not this 30 or this 15 is closer, certainly these numbers getting into the high 30s, we're looking a little bit pricey. You've seen the price come back down, but there's a question of, well, how do we evaluate it just as we sit today? And again, this is where the forecasting calculator, I think, really comes in handy. We have the analyst estimates. It's always good to check the analyst scorecard and see how a company is done relative to analyst estimates. And you can see, although the analysts have been off by greater than 10% quite a few times, anytime it's been a bigger than 10% deviation from what analysts were expecting, Broadcom has been a winner. So Broadcom tends to perform in line or better with expectations most of the time. So the analysts seem to have some idea. Somebody had asked in a comment to a previous video, how many analysts do I look for? It's a great question that's hard to give a real specific answer to. The main thing I'd say is the fewer the analysts you have, the more the average can get skewed by one analyst that's either quite a bit more pessimistic or quite a bit more optimistic than the rest. So that's something to look at. So anything over 5, it starts to net those out a little bit more. But when you get into double-digit analysts, Broadcom's got 25 most recently. That's kind of fluctuated from 12 to into the 30s over the period here. But fewer than 5, you just got to keep in mind that each one of those analysts carries, relatively speaking, quite a bit of weight. So that's something to keep in mind. But the forecasting calculator really allows us to say, okay, let's assume they do hit these analyst estimates. And here's the range of outcomes based on the different multiples. And of course, they've been over a 30 PE recently, so you can see what kind of returns that would look like. But you can also see that historically Broadcom has traded maybe more at a 15 multiple. And so, that kind of bounds you between, hey, that's quite a bit of downside if they fall all the way back to a 15. If they go back up to that 30 plus multiple we've seen them at relatively recently, that's quite a bit upside. So how do you kind of know what might be reasonable? Well, again, the PE equal to the growth rate, I think, is a pretty reasonable check. And so they're expected to have operating earnings growth of around 21%. That's why you see this 21 multiple as sort of the middle part of this. And so that kind of gives you the middle ground, which if they hit that growth rate would be sort of considered, roughly speaking, a fair value. So I like the Broadcom example because it shows the power of sustained growth and the power of compounding and why that can be so attractive. It also shows the difficulty in real time as we sit here today. You can't gain from what Broadcom has done in the past. You can only gain from what they're going to do, right? So yes, it's great that Broadcom has had this great run, but what about right now? What do I do right now? That is a different story. And again, I come back to this to keep it kind of simple on the valuation side. Something like the PE should equal the growth rate, I think, is a pretty good rule of thumb to help guide you on these kind of companies. So again, growth stocks, it doesn't necessarily have to mean that they lose money, but sometimes people think of companies like Tesla, especially in the early years. If you go back and look over this timeline, they had one positive earning in 13 and they sort of broke even in 19. But, you know, the first decade or so of Tesla history saw them with negative earnings. And you would see similar types of results if you looked at things like operating cash flow, which was mostly speaking negative over this period of time, free cash flow to equity, mostly negative over this period of time. So I've got, you know, operating earnings up here, but the various metrics tell pretty much the same story, that Tesla in the early years was losing money, negative cash flow, and those types of firms can be very difficult to value and very difficult to know, are you paying a reasonable price? And so I wanted to talk a little bit about how you might handle these kinds of companies. Well, first of all, one metric that's always positive is sales. And so if we take a look at the sales of Tesla, and this is just, again, without the price line, just with the fundamental on here, you know, very, very low, obviously in the early days, growing. But now we also have a growth rate. They've grown sales at about a 44% rate over this period of time, which again is an incredible growth rate. They've sustained it for quite a while. 24, you know, we're looking at a much lower growth rate, but back up to near 20% growth in 25 and 26. So this is a company that's expected to sort of have ongoing growth. I'm going to add the price line back here to Tesla just to see that, you know, especially in the early years, they've traded over this period about a 9.82 price to sales. And, you know, through about 15, they tracked relatively close to that, kind of stayed below that line for quite a while as the stock, you know, relatively to more modern times wasn't sort of seeing these big spikes up. And then, of course, you get this big run up where that from, you know, 19 through early 21, you know, Tesla was up about 2,000% in total over that period of time. And of course, they've come back down quite a bit over that period of time. So they're down about 50%. I talked about this on Broadcom as well. But when you're dealing with growth stocks, you are going to see, again, some swings. You're going to see some big moves. And that's why you have to come back to the fundamental story. And I think one of the fundamental stories that people have been wondering about Tesla is, obviously Tesla is, you know, maybe the purest play on electric vehicles. There are other publicly traded EV companies now, obviously, but especially if you think about in the U.S., Tesla been around and has had, you know, good success in terms of sales growth. So I think a big part of how you think about Tesla depends on how you think about the future of the EV market, because the adoption of EVs is going to be a big part of their growth story. The other part, of course, is going to be what's their competitive position within the EV market. And so those are the stories you really want to come back to, rather than worrying about these price movements and seeing what goes on and trying to react to that. You really need to go back to the fundamental story of the growth to help you make decisions. And finally, I'd say while you can look at ratios like price to sales to try to value these kind of companies, really sales do not create value necessarily for us shareholders, right? Cash flow does. So it's really about the cash they're going to generate. A lot of times operating earnings is, you know, sort of a reasonable enough proxy for cash that we just talk about earnings as almost like that is what we're talking about. And I don't really want to get into the difference between cash flows and earnings and those kinds of things. But the idea is once you subtract all the expenses, there's got to be something left over for investors, right? For there to be some value here. So while we can look at price to sales, also looking to the future where a firm might be profitable, or once they get profitable, or once they start generating positive cash flows, then we can use more conventional valuation approaches to give us some idea. So again, if we go to look at operating earnings, really starting in 20, Tesla started showing pretty consistent positive earnings. They had some declines, including through 24. Again, expected to have a pretty big growth rate in 25 and 26 of, you know, 40 and 33%. So you're looking now at some the sales growth is still, you know, in the 20s during that period. Earnings growth in the 30s and 40s. So pretty healthy earnings growth projected. As always, I really recommend going to the forecasting calculator, though, to get some idea. And first of all, what we see here is the earnings multiple that Tesla has been trading at is very, very high, this 82. And again, it's like, is that too high? It depends on the growth. If they had earnings growth of around 82%, then that could absolutely make sense. At the earnings growth that they have had, a little bit different. You know, the overall growth rate here that's used is 25. That's why this 25 is the bullseye. And so it says, hey, if they hit those growth numbers and they trade at the multiple suggested here, you know, it suggests some possible downside. If you look at just kind of the last 2 years of the forecast, you know, more like in the 35 or 40 range, this gives them a 37-ish PE here. You know, quite a bit less downside, but still downside from where they're at currently. So these are some ways that you can really start to tackle these tricky situations of companies that are relatively early in their history of generating earnings or haven't generated any positive earnings yet, is to ask, hey, when they do, what's that going to look like? What kind of growth rate might they have? And then what kind of price will allow me to really be able to benefit from their fundamental growth? Because that's really where the valuation side comes into play with growth stocks.
Thank you, Nathan. Really appreciate that. You know, as I said in the intro, GARP, or growth at a reasonable price, is what growth stock investing really needs to be about. It's very easy to get caught up in it. And the point you made about, you know, being a long-term investor in growth stocks is so critically important. And I've talked about that in the past also, because with growth comes great volatility, and investors have to really convince themselves that they can handle the volatility that comes with growth stock investings. Anyway, thanks for the insights. We appreciate it. If you like this video, give us a like, subscribe to our YouTube channel, you know, ring the bell, and take a look at investing some of your hard-earned money into FastGraphs, because it'll help you be a better investor in the long run. Thanks for watching.